Thermax as well is the other one. We'll talk about that in greater detail in a bit. But Thermax is up almost about 4% right now. But let's do one thing. Let's thank all our guests for joining us and try and get our market master into the discussion. Ajay Srivastava of Dimensions Consulting is joining us in just a bit. Ajay, hi, good morning and Happy New Year to you. Thank you so much for being with us on the channel. What a great start it's been to the year, right? The bulls seem to have tightened their grip further on the market, but with the Omicron variant, you never know which way things could go. How are you feeling about the markets now?
Well, Sonia, the money and hope and fearlessness will beat any COVID variant. I think, India, if you travel around, COVID is all of cities. Step out of cities, what is COVID here? But I'm not saying, that people are not taking chances. But the fact remains that, investors, people are taking a much more longer term view. That is one. Number two is cash not going to business is being deployed in the stock market. So liquidity is abundantly coming through the system. We bought through the FI holding. So it's a flow which is continuing and which is helping us. The very good part, and I think that's a good part, is the Indian market has become bigger. So many new listings give so many new choices. So I think your depth of market also is now changing the perception of people, plus encourages mutual fund to buy more. So all in all, as you enter 2022, I think you enter with a lot of hope, Omicron notwithstanding, and people who are getting it for, whatever, I'm sure your friends and colleagues have got it as well, are not reporting such a bad situation compared to last March or April that hospital beds were running. So I think there is a lot of hope, a lot of depth in the market, a lot of new options in the market. Great way to play the next 5 years of this Indian stock market.
All right, Ajay, morning. Thanks so much for joining in. Ajay, what about for 2022? The auto sector had a bit of an off year in 2021. Indications are that maybe things will ease out and that sector could look up. Do you believe in that, or would you wait to buy auto stocks after a bit of a dip?
No, I think auto will look up, definitely look up. There is a lot of pent-up demand. People couldn't find the cars they buy. The sad part is that in an economy like India, we are seeing a de-acceleration in two-wheelers, and that's going to face further pressure because the new two-wheelers coming into the market, the EVs, new two-wheelers, are going to put huge pressure on the existing two majors. So I think two-wheeler market in auto will see a lot of strain, not only because of demand, as the new players coming in, they're going to eat up the market share quite substantially. I think that's where the problem is. Car industry, I don't think has a problem. SUV, I don't think has a problem. You've seen the kind of demand is coming through for BMW, had the best year ever. Now, that doesn't say much about equality in a country of ours, but it does say that the upper segment, the car owning segment, is definitely up there and waiting to buy more. I think there'll be a lot of pent-up demand. Auto companies, by and large, I don't think you have a worry at this point of time. Unfortunately, you don't have good stocks. Barring Maruti, you don't have a stock of auto in this country. So to that extent, you're limited. But I think as an industry, as an auto ancillary industry, investors, I think you'll have a great time this year. Also, cost pressures are lower, much lower. Steel is down, aluminum is stable. To that extent, I think there is ability to absorb cost pressures. Therefore, I think industry-wise, I think ancillaries will do a lot better, perhaps, than even the main auto companies, also because of export.
You sound a lot more optimistic than what you were some months ago, Ajay. So, the point is that by virtue of their first-in-line nature, financials are likely to do well. In that case, how would you play it? Via private banks, via public sector banks, or maybe NBFCs?
See, I think we have declared a call in early of 2021 that we were not investing in any banking stock. And for the whole year, we have not invested.
Okay.
The call is now different. And I think the reason 2022 may be different is only for large banks. And the reason the call is that if you see what happened to SRE, if you see what happened to RBL Bank, a lot more smaller banks could go down the path of RBL Bank. Which means what? Which means that 4 largest Indian banks are going to get market share out of the smaller banks. So I think as a banking strategy, it is wise to now get into larger banks, not necessarily smaller banks, because what happened in RBL could happen to any of the smaller banks. They don't have the cushion to do much in terms of withstanding the NPAs. So I think there is a need perhaps now with interest rates up, which gives better NIM margins to the bank, smaller banks in trouble. NBFC industry out of favor with RBI. SRE got no benefits. SRE got slobbered absolutely by the RBI. So NBFC industry is not there. The fintechs are under pressure at this point of time. The small banks under pressure. NIMs are up. Big banks become a good investment case for 2022, unlike 2021.
Okay, well, Just stay on, Ajay. We have an update that's coming in on IndusInd Bank this morning, right? So let's get my colleague Abhishek in quickly, and then I'll come back to you for some of these banks. Abhishek, over to you.
Well, Sonia, as you mentioned, IndusInd Bank has given the business update. But just to remember, last year, same quarter, they had the benefit of loan book declining on a YY basis, which has helped this time around. So deposits are up 18.9% YY and 3.4% sequentially. The loan growth is at 10.1% YY. With the base effect, you need to take that into account, and up about 3.3% sequentially. So industry level, the loan growth was around 3.25, 3.26% sequentially, so nothing great over there. However, the good point is that the CASA ratio is at 8-quarter high of 42.2% when compared to 42.1% in the previous quarter, and retail deposits are up about 1.7% quarter on quarter. On the flip side, the credit deposit ratio has declined YOY and quarter on quarter to 80.1%, which could keep the pressure on net interest income or net interest margin in Q3. Back to you.
Okay, thanks Abhishek for that. Well, coming back to this discussion, Ajay, you spoke about banks, but I wanted your particular views on names like Bajaj Finance in the NBFC space. Clearly, there's so much traction over there. Retail financing is back in a big way. Is this just the start of some sort of an upcycle, or would you be a bit cautious here?
No, I think, Bajaj Finance, I would put in a different block compared to regular NBFCs. Because I think they have a major focus now on service businesses as well. In Bajaj Finance, it's not a pure lending institution. Plus, it's got pedigree, it's got capital, it's got everything going for it, except it doesn't have a banking license. I think that's the bottom line. So I think Bajaj Finance, you put it in a separate block and says, that's a kind of, if you want to buy NBFCs, you must start with Bajaj Finance. There is no other way to start it. But now leave aside Bajaj Finance. Now, which is the next NBFC you want to buy in this market? Zero. Absolutely zero. You've seen what happened to Shriram group companies. They didn't perform at all for so many years. Then you go down and say, which is the next NBFC you're comfortable buying? And you won't find a single item. So, so that shows very clearly that the regulatory mechanism of this country has ensured that NBFCs will not thrive in this economy and will not give competition to the bank. And that's the mojo of the bank, is the CASA. NBFCs typically eat up the CASA. The fintechs eat up the CASA, but that's what's being protected. So therefore, big banks will still remain the favorite of RBI. NBFCs barring next to Bajaj Finance, I can't even find the next one to buy into. Maybe Piramal, when it splits, it comes out, it'll become a good buy. But there is no other second NBFC you like to buy in this market.
Large banks and Bajaj Finance, that should be on top of the list. Ajay, by the way, we're talking about banking names. I think we should just pull up the banking index. It's had a great start today. It's up close to around 300 points odd. And it's on its way to move towards that 50 DMA that we were talking about earlier today, just around 180 points odd. Now, given the way the Nifty bank has moved, the Nifty is not getting much support. I mean, it's only more or less flattish despite the big outperformance that we're seeing coming in from the Nifty bank. But Ajay, let's shift focus away from banks' financials. What about these new age companies? What's your take? Invest in them or just stay a customer of them and, use the apps, use their services, but don't invest?
I keep saying that how can you not invest? There can be no investment case, but you can't say I will not invest to them because some of them will definitely come through in terms of either acquisition opportunities or will be the growth opportunities. It's a game where you have to play to keep buying and adding up. And you got to figure it out at the end of the 5-year period from today. Your gig economy stocks should be at least 30-40% of your portfolio. Now you got to reach that. You can't reach that starting, but you need to start somewhere. So we have all arguments against the valuation of these companies, and I don't want to argue on that. But the point remains that these companies are going to be with us for the next 5-10 years of our life. Therefore, we need to invest in them. What you can do is invest slowly, gradually, but I would say definitely have a plan that it should be 30 to 50% of your equity portfolio in 5 years' time. And that's, if you're not doing that, I think you're going to waste a lot of your money because as US has shown, old economy stocks, no matter how well they do not get valued because there is no traction, there is no excitement, there is no investors coming into the thing. Investment is not about just balance sheet. There are hundreds of companies with P's of 3 and 4 in this market. Look at the steel industry, 4P. Look at Vardhaman Textiles, growing at 30%, 10P at the end of the day. And I've got a holding in that, so for disclosure. But the fact remains, money goes and equity prices rise where money goes. Money goes to the gig economy stocks in the US, everywhere in the world, it'll happen in India. You're going to miss out if you keep sitting on the sideline waiting for correction. You will get correction, add on. but not say that I will have nothing in the stock. I think that will be not a sensible strategy at all for India or for any market whatsoever.
That's a big call you're making,
Yeah.
30 to 50% of your portfolio in these
Yes.
new economy stocks. In fact, that calls for a much longer conversation that we'll have with you with regards to how do you value, how do you view these companies as well, because the traditional valuation metrics do not matter or do not fit in the framework that we're looking at. But, Nigel, you were talking about how the Nifty Bank is outperforming and the Nifty is underperforming.
Yeah.
There's only two factors what has led to the Nifty's underperformance. One is IT, the second one is Reliance. Both these, Reliance, if you call it a sector, if you must, given its weight on the index currently at the low point of trade, and the IT index as well is lower. And Ajay, that brings me to the next question. IT index did about 50% in terms of growth in the index level itself in 2021. A lot of the street is believing for an encore in 2022. Do you think that's possible? We have big three numbers due in just a few days.
Oh, certainly, Mangalam, is possible, and the reason is this is one sector where you don't see equity dilution. You see buybacks, you see dividends, but you have never seen equity dilution in the top 3 or 4 companies in the last decade or maybe more than a decade. Now that calls for a great thing that these are new age companies to start with, no equity dilution happening, plus buybacks happening over a period of year on year. So as an investor, you are in a good state of a company, strong cash flows, money being shared with shareholders, business traction is pretty good because no new company can come up and become an Infosys overnight at the end of the day. So as a sector, the top 4 companies, and of course, I will leave it to you to say that, yes, the smaller ITs have done better than the larger ITs. That is true. But I would still say the larger ITs, because of lack of equity dilution, giving money back to shareholders, perform the best example of investment thesis. Compare that to ITC, and you understand what I see, why ITC doesn't perform and why IT performs in spite of this one. So I think this sector will perform. Some years it may do very well, some years it will do mediocre, but you can't not have them in the portfolio. This is, I would say, adjunct to gig economy because these are supporting cast to the main gig economy companies.
So say 4 years from now, you have 30 to 50%, call it 40% in new economy and
Yes.
some in IT. What would your ideal portfolio mix be?
See, ideal would be that 30 to 40% has to be the new gig economy stocks. Definitely, they're going to be there. 10 to 20% is an IT and pharma put together, the large pharma services companies. We would like to be there. And the balance 30, 40% should be in growth stories which are coming out. Even today, you see a lot of growth stories. Let's take an example like GHCL. We have a holding there. It's just sold its home improvement business, splitting the company into 2 ways, textile spinning and soda ash. Wonderful opportunity. You saw what happened in Advent. When Advent took in Forbes, price was shot up from 4,500 or whatever to 6,000. GMR, split of the company giving approach. So, at any point of time, India will go through major opportunities of restructuring, and the next 3 to 5 years is going to be the big era of restructuring. And you've already seen every single restructuring has given tremendous value to shareholders. Keep looking for them. Don't worry about P&L. Don't worry about this split, and this reorganization are going to give you value. So 20% of your holding should be in stocks undergoing restructuring at any point of time. Balance 20, you like to keep a Titan. Sure, keep a Titan because you want to keep a Titan. You want to keep a PVR because that's the success stories, consumer stories of India. So it's pretty easy at the end of the day, Indian portfolios, because some stalwarts will remain stalwarts in the market in whether jewelry space or the multiplex space.
Okay, all right, Ajay, it's been a good chat with you. Wishing you all the best for
Thank you,
2022. Stay safe and, in fact, have a good, prosperous year ahead. Well, that brings us to our first corporate